Today's jobs report just dropped a bombshell on Wall Street, and it's causing huge moves in the bond and equity market. Today, we got a huge miss in non farm payrolls, way below Wall Street consensus, and a revision that's sparking a lot of discussion. This comes on the heels of a surprisingly strong ISM Services report yesterday. So, what's it all mean? Here we can see the S&P 500, which had gapped up higher, has been just absolutely cratering since the market opened. First, before we get to non-farm payrolls, I want to briefly address the ISM Services report. Remember that 72% of GDP for the U.S. economy comes from services. Here is that ISM Services report, and we can see that prices, new orders, and business activity all remain above 50. Remember, with ISM, anything above 50 indicates expansion. Anything below 50, like employment, as we see here in blue, is in contraction. Now, what I want to show, the reason that this is important is twofold. So here's new orders, and here's the correlation to real GDP. So real GDP here, this is the inflation adjusted rate of change of the US economy. Here we can see the annual growth rate, and the correlation with ISM Services new orders is a very, very strong. Now, not only do new orders predict the real GDP or the growth rate of the US economy, but if we go to ISM prices and put a 4-month lag on ISM prices, we can see that this has a strong correlation to CPI. So this chart goes back to 2000. And again, what ISM prices paid shows you today shows you the direction that CPI will likely head over the next quarter or so. Here we have a 4-month lag, and you can see that that's about right. Maybe it's a 3-month lag depending on the quarter or the year. But in general, there's about a 3 or 4-month lag between when ISM Services prices start registering to when you start to see it in consumer price index inflation. And as we can see, it has been moving sharply higher. Again, this kind of goes into the reacceleration of nominal growth, led both by a growth in real GDP as ISM Services. This is a strong report, no doubt, as that shows with business activity and new orders is telegraphing a reacceleration of real GDP. But then we also have a reacceleration of inflation likely ahead of us. This is what just keeps coming up no matter what we look at. Remember here, for example, is ISM manufacturing, which we got 2 days ago. And this is the predictive ability of the ISM manufacturing prices report to telegraph what producer price index is going to be. This has a 7-month lag. So this is why these reports are important. By the way, ISM manufacturing prices is doing something very similar to what ISM Services prices are doing. And we also had new orders for manufacturing just barely tick into expansion territory. So here's the non-farm payrolls report, and it came in way lower than expected. We came in at 22,000 payrolls created for the month of August versus an expectation of 75,000. Now, the U.S. economy still added jobs. However, there were some revisions. And as we can see, July was actually revised up slightly from 73,000 up to 79,000. But June, 2 months ago, was revised down significantly into negative territory. So June, 13,000 jobs were lost in the US economy. And as we can see, the rate of growth, remember, this is the number of new payroll, new jobs being created in the US economy, that is slowing significantly. This chart goes back to 2006, and we can see that, this reading of about 20,000 is very, very low by historical standards. Now, there is a degree of normalization going on in the labor market, and this comes as a result of what happened in 2020, as well as the kind of immigration story that also kind of happened under the last administration. Some of that is kind of being normalized into this administration. So there's kind of 2 degrees of normalization that are occurring here. So far, we have not seen the unemployment rate spike. Here is that headline unemployment rate. This is lagged. It hasn't updated yet. It's 4.3. Um, but it still remains very low compared to historical standards. This chart goes all the way back to the early 70s, and we can see that U3, which is what headline unemployment read is technically reading from, is still very, very low compared to historical standards. Very, very low. Now, if you count U6, which is a much broader, more accurate way to measure unemployment, that is basically double what the headline unemployment rate is at 7.9. U6 starts to count part-time for economic reasons, discouraged workers, right? It's a broader way of measuring unemployment, probably a more accurate way of measuring unemployment. That is running at about 8%. And this is slightly higher than the lows that we had seen here versus U3 headline unemployment, which is running very near the lows. Again, going back to the 70s. Now, it's important to point out that the labor force participation rate, this is a huge story when it comes to the unemployment rate and how it might be not the most accurate. Peruvian Bull on X has a great thread. If you search his profile, I'll try to put it in the description, but a great thread on why this labor force participation rate matters so much and has been cratering. So going back to kind of the late 90s, early 2000s, like a lot of other things, this has been headed just down. We set a peak here of about 67.3% in terms of labor force participation rate. That is down to 62.2. So we went from about 67.3 down to 62.2. Now, this is not the case just in the US. The labor force participation rate has been headed lower across the West kind of more broadly. So here we're going to get into the actual report. The ISM Services report, I will link. It is very strong. There's really no two ways about it. Business activity, new orders, and of course prices, that inflationary pressure. ISM Services, which is 72% of the U.S. economy, came in quite robust. So they note a job gain in healthcare, which was partially offset by losses in the federal government and in mining, quarrying, oil, and gas extraction. I'm not an energy expert, but from what I have heard from those that follow the energy markets closely, shale is a big a drag right now in terms of that manufacturing employment. Here, by the way, we can see the number of new jobs being added per month is clearly declining going back to 2023. So we have a 2.5-year downtrend in number of new jobs being created. Again, some of that is just normalization. Unemployment rate remains at 4.3. Unemployed people remains at 7.4 million. Now, I did want to point this out. I didn't put this yesterday on the Jolts video. I did not include this visualization, but hopefully this makes the point a little bit more clear, which is, yes, job openings have dipped below the unemployment level. So the number of people unemployed, the number of openings has dipped below that. But if you look, this chart goes back to 2000, so 25 years of history. You can see that the period of time where openings are below unemployment is the norm, going back again all the way back 25 years. So while the unemployment rate is starting to tick up gradually, 4.2 to 4.3 is not violent yet, not nonlinear yet. It is important with the Jolt story in terms of the labor market is certainly tightening, but it is not necessarily all that abnormal to have job openings fewer than the number of unemployed, as you can see from 2000 all the way through up until 2018, where it barely kind of ticked positive. This spread has been negative. So this is kind of the norm more than anything else. So that piece of context hopefully is important. Now, the labor market is certainly cooling. That much is sure. So in August, the labor force participation rate changed little. It is still very far below the peak that it set 25 years ago. Here is really, I think, where more focus needs to be when it comes to the labor market. So the number of people that are part-time for economic reasons, 4.7 million. This changed little in August. These are people that would have preferred full-time employment, but were working part-time because their hours had been reduced or they were unable to find full-time jobs. So they want full-time employment, but they cannot get it because maybe the business is not able to offer them full-time employment with benefits. The number of people not in the labor force who want a job is 6.4 million. So you're already talking like 11 million people here, just part-time for economic reasons and not in the labor force, but who want a job. Just those two categories combined, you're already at about 11 million. They are not counted as unemployed because they were not actively looking for work during the survey window. So those that are not in the labor force but want a job are not counted in the headline number, the headline unemployment number that you will hear reported on the nightly news, this U3 number. Those people are not counted simply because they were not looking for work during the survey period. Now, there's also marginally attached to the labor force. This changed little, but stands at 1.8 million. By the way, not in the labor force who currently want a job is up by almost a million people year over year, 722,000. Now, those marginally attached to the labor force changed little, 1.8 million, so another almost 2 million people. These are individuals who wanted and were available for work and had looked for a job sometime in the prior 12 months, but had not looked for work in the 4 weeks preceding the survey. Again, just because they did not look for work during the survey window, they are not counted. The number of discouraged workers, a subset of the marginally attached, these are people who believe no jobs were available for them, changed little over the month, but is running at 500,000 people. So healthcare continues to add jobs, although it is adding jobs below the average gain that the healthcare sector has shown, below that kind of 12-month moving average. So healthcare is still adding jobs, but healthcare is adding fewer jobs than the average over the past 12 months. Social assistance also continues to trend up. I think there's a statement in here about the health of an economy where the fastest growing sectors are healthcare and social assistance. You go back for the past 5 years, it was healthcare, social assistance, and government. Now government is starting to reverse. This declined further. I did think it's interesting. It's down by 97,000 since January. This is the Doge and the layoffs. But I thought this was interesting. Employees on paid leave or receiving severance pay are counted as employed. So this 97,000 is probably much higher. Wholesale trade, we noted this in the, I believe it's a BEA report that we went over a couple days ago. Employment continued to trend down there by 12,000. It's fallen by 32,000 since May. Manufacturing, as we just saw, employment changed very little in August, down 12,000, but is down again 78,000 over the year. Employment showed little change over the month in other major industries, including construction, retail trade, transportation, warehousing, information, financial activities, professional and business services, leisure and hospitality, and other services. Remember, services are 72% of the U.S. economy, excluding government services. So here, average hourly earnings, the wage story. Over the past 12 months, average hourly earnings have increased by 3.7%. And then here are those revisions. So change in the non-farm payroll employment for June was revised down by 27,000 from a reading of 14,000, positive 14,000, to a negative reading of 13,000. July was revised up slightly. So that is the non-farm payrolls report and all of the most important findings in it. I did want to take this opportunity to address the wage story. So here we're looking at M2 money supply growth on a year-over-year rate of change basis, and then we're looking at the nominal wage growth as calculated by these BLS surveys. And what we can see, again, remember, inflation is a monetary phenomenon. As the money supply expands, as the money supply grows, mainly, by the way, by private banks extending new loans, new credit, that is credit creation, that creates new dollars, new money in the new monetary units in the money supply. That is about 90% of all dollar creation is caused by private banks. As they extend new debt or new loans and create new dollars, that is what we're seeing, the rate of the money supply growth. This is literal inflation. Inflation, remember, refers to an inflation of the money supply. So let's look at the rate of change of the money supply. Here, by the way, we're looking at broad money. M0 is base money, and that's kind of official money created by the Fed and the Treasury. Here, we're looking at broad money, which is probably a better way to do it. And then we're looking at wage growth nominal. So anytime the white line is below the red line, the average American is suffering. And just in case this point hasn't been made clear by all of our other videos, nominal earnings for the second quartile. It looks great. And this is what is reported by most media outlets. They will show this nominal number. But again, inflation is a monetary phenomenon. So let's look at those nominal earnings denominated in the money supply. Again, if the money supply is growing faster than nominal earnings, this line will go down. This is the real inflation adjusted monetary unit, money supply adjusted purchasing power of the second quartile weekly wage. Now, some people are probably saying, oh, well, you need to adjust it for population. Okay, so here is the total civilian annual wages. Use the average hourly wage multiplied by the labor force, multiplied by 1820, which is the number of hours on average being worked per year, and then divided that by the money supply. And it's the same story. Now, I want to point out that back in the early 80s, total wages as a share of the money supply was about 89%. Well, that number now, 44%. So again, as the